Hey everybody, hope all is well. Back for an update on safe investing. We're nearing the end of February and had some adjustments since the beginning of the year and through the end of the year. So I wanted to update everybody on the different safe investing choices that we have out there. So let's start with bonds. Bonds through history, through the last 30, 40 years have been the benchmark of all safe investing, but we're starting to realize they're not as safe as we thought they were. The biggest problem is as interest rates go down, like they have been for the last 40 years, the value of bonds kept going up, okay? So when we hit zero in interest rates, the value of that investment is the highest it will ever be. So that's when we start getting out of bonds. And then as interest rates rise, and every time we have inflation, they raise interest rates, so then the value of your investment goes down. So if you didn't get out of bonds, then you have a situation where you keep losing value every time interest rates go up. And if we keep seeing inflation, they're going to keep pushing interest rates up. So we want to try to stay away from bonds during inflationary periods, and they're a little bit unpredictable. The reality is we're still in very low interest rates. Bonds are still not necessarily the right investment for most people. If you have a really long outlook into the future, okay, maybe hang on to some bonds, get some bonds, but you have to diversify at minimum, okay? Diversify the safe investments at minimum, okay? So retirees, terrible idea. You know, look, if we go back to 12, 14, 18% interest rates, great. You want to go buy 30-year bonds, please do. But until then, I'm not going to sit here and tell you that bonds are the right safe investments for any retiree, because every time we see inflation, you're going to lose money in your safe investments. Looking at these interest rates, the entire investing world knows that BBB is at risk. The longer we stay up higher in these interest rates, the more of these BBBs are going to fall into junk bond status. So you've got to be careful. We've got risk in the BBB category, and it's showing up in the returns. You're looking at 7% on a 30-year BBB bond right now, compared to the 5.6 on a single A. That's a big jump, okay? So be careful about your bonds. Interest rates out there pretty flat across the bond spectrum here. Double A's, you're looking at 4%, somewhere around there. And then AAAs, you're still in the 4s as well. So mid 4s, if you're looking for safe returns, pretty much everything's in the mid 4s. Why would you take these? Because they have risk, right? There's the 4s. Well, hey, guess what? Treasuries, you can do the same thing. You can make 4s with zero risk. Treasuries are perceived as zero risk because they're backed by our federal government's printing machine. They'll just print you some more money if they run out. So treasury bills, it's $100 minimum. These are the short-term investments, weeks. The longer we have interest rates this high, the more the feds have to pay in interest because they keep maturing and renewing at much higher interest rates. 4 weeks are at 4.46%. And you can see how flat interest rates are. 52 weeks is also at 4.45, only 0.1% difference. So not much of a difference on the term in terms of the length of time that you're investing. And you will still see the inversion on the longer interest rates. The 2 and 10 is the traditional way to look at our interest rates and see if we've inverted our yield curve, which we have. You go out 10 years, you're only going to make 3.74 versus the 2 years paying 4.61. Okay, so 2 years or less with the treasuries is what you're looking for. You're making the 4.5% range, which is pretty much where all the safe bonds, no matter what term you went with, that's what they're paying right now. And then the I bonds always seem to be interesting to people. I actually ran into somebody that had 20-year-old I bonds, and it was so cool because I think they were paying a 4% guaranteed interest rate on top of the calculation of the CPI. So, and what's been so cool about that is the calculation, the change in the CPI, the Consumer Price Index urban, was about 9%, and you take 4% on top of that, you're making 13% on an I bond. That sounds so wonderful. But the problem is you go buy those right now, all right? You got a 30-year term. That's a long term. And they're paying a guaranteed interest rate of 0. And this is the change in the CPIU. Okay. So if costs start coming back down, all of a sudden they're going to have negative interest rates on these things. You know, they limit you to $10,000 on these I bonds too. Not really a safe investing plan, but you got some money, 20 years ago, you put them into these, they actually started looking pretty good for a little while there. All right. Now, CDs with insurance companies. The bank CDs, honestly, it's just not a huge amount of use for them. We're starting to see 5% out there, a little bit here and there, but for the most part, the bank CDs are all paying about 4.5%. Okay. If you really search and you go with these, tiny little credit unions in the middle of nowhere that flash their interest rates up to get money in the door and then pull them back down, yeah, you might get 5% out there. But when you look at these multi-year guarantee annuities, yes, the word annuity turns a lot of people off, but it's just a stigma. You've got to actually look at these because there's not one dinner seminar selling these things. They don't pay a big commission. So this is not any sales stunt. These things are better than CDs. They're better than bonds, and they should be in everybody's portfolio, but they're not because the person that is advising you wants to make money. And that's the problem we have, right? They want to make 1% a year to manage that bond portfolio. They want to make the commissions when they buy and sell those bonds. They want to sell you bigger commission products. They want. Okay. Fixed annuities or multi-year guarantee annuities by far are the best fixed investment out there, fixed rate investment out there. These are CDs from insurance companies. I just made a video comparing CDs versus multi-year guarantee annuities, highlighting the differences and the similarities. Okay. It's a fixed interest rate for a fixed period of time. You see the years, 2 years, all the way to 10 years. Typically, the 5-year is the sweet spot. Right now, technically, the 6-year might be the sweet spot for 0.5 or 0.05% better interest rate. But, that's all the same. Okay. So when we look at this, these multi-year guarantee annuities, the difference between a CD and these is you're going to have access to your money here. And that's why they're able to invest it for a longer period of time. You're pushed into the 6-month or 18-month or 12-month CDs because you can't touch your money. Whereas with these, every year you're going to have access to 10% of your money, typically after the first year, but you'll have access to 10% of your money. So if you had 100,000 in there, you have access to 10,000. If you have $1 million in here, you have access to $100,000 every year. So for a lot of people, the 10%, if properly used in a portfolio and thought out in terms of liquidity, this ends up being actually just enough. It's a good thing. It ends up giving you plenty of access in a lot of situations. You can use these in IRAs. You can take required minimum distributions out of them. They're very friendly to people's situations that need to pull money out. Okay. So you can see these are higher interest rates than CDs as well. And there's no fees and there's no risk. Let me repeat that. There's no fees. The commission that the insurance company pays to the advisor is not from your pocket. Okay. It's just like a bank CD. They paid that kid that wrote the CD up for you. They paid him a commission, and we don't ask where those fees are coming from. If they're paying you 5.4%, I'll be honest, they're probably going to make 7 or 8% the way they invest it. They do a lot more corporate lending. Banks do auto loans and credit cards and things like that. Okay, so their banks and insurance companies do the same thing. They borrow your money, pay you some interest, go invest it, and hope to make more than they had to pay you. It's the same thing. Safe as safe gets. Okay. There's no risk difference between CDs at a bank and these. They have the same protections. One's from FDIC, the other one's from the state insurance departments, but they also, regulators have forced these to reinsure each other. So if one company goes out of business, somebody else was guaranteeing that business anyways. Okay. Then the one last one I like to go through is these fixed indexed annuities. Okay, so I highlighted one last month. This is a different one that's out there. The thing that I really love about the change in these fixed indexed annuities in the last few months is the fact that we have guaranteed to term rates. They can't change your interest rates year over year. And that's a huge difference and gives us a ton of confidence in these things. So the reason the fixed indexed annuity, the good ones, are better than fixed annuities, there's several reasons, but understand being stuck in a fixed interest rate. If interest rates keep going higher and higher and higher, then you're always falling behind, okay? The flexibility you have in a fixed indexed annuity is the fact that you do still have that fixed interest rate as an option, and every year you get to change how you earn interest. So if you want to be tied to how the stock market does without the risk, some years, that's great. You have the potential to get paid a lot more interest. Whereas times like right now, everybody just wants to sit in a fixed rate. Great, you can move it right into the fixed rate. Every year you can change how you invest this money within the same safe investment with no risk and no fees. And the returns that you get in this historically have always been way better than any fixed rate out there, giving you a much better chance of keeping up with inflation. And that, especially for retirees, is the main objective. Find some safe investments that have a better chance of keeping up with inflation, right? The majority of retirees don't lose your money and do the best you can to keep up with inflation, and you'll have a very comfortable, enjoyable retirement. So when we look at this one, we've got a great fixed rate, and technically there's 6 different indexing options. 3 of them are good. The other 3 we don't even utilize very often because they have a charge, a fee to use those. So no fees in the other 3, plus there's no fees in the fixed interest rate. You can choose indexing that does have a fee because they give you a much higher potential earning, okay? Now, ability to change your strategy each year gives us that flexibility to handle whatever the world throws at us going forward. 10% penalty-free access after the first year. That's huge. That gives us the ability to use this money. Putting these in an IRA is a great idea, especially as you start needing to pull money out of there every single year. I always tell people, as you head into retirement, you need to start pushing safe investments into the part of your portfolio that you're going to be pulling from, okay? And for most of us, it's going to be IRA money the day we retire. 100% access after 5 or 10 years. There's 2 different products on the market that have guaranteed rates. That's huge. That's never been around. These guaranteed rates are guaranteed for 5 or 10 years, and then you have 100% access. Most offer 100%, 50 to 100% penalty-free access if you happen to go into long-term care. Okay, and then if you pass away, your heirs get 100%. Okay, the full account value you have access to if you go into long-term care, the full account value goes straight to heirs without probate. You list beneficiaries on the contract itself, and the money goes straight to your heirs when you pass away. And there's still no fees and no risk in these things. Look at these returns. Just look at the top 3 indices. You've got BlackRock, you've got Fidelity, and you've got the S&P. 3 major companies, 3 different indices. They're paying 170 and 175% of whatever these stock indices do. Look at the last 10 years. Look at the high and low. That's fantastic. These are safe investments that are guaranteed for 5 and 10 years. And look at the annual compound rate of return. Annual average compound rate of return. You're talking 10, 8, 7% in most of these cases. The last 10 years, the best one was the BlackRock. Okay, that's the socially responsible index that's under fire right now. But still, having a safe investment with that type of earning power is pretty fantastic. When the markets crash, you earn nothing, but you lose nothing. When the markets go up, you have much better potential returns. You have a fixed rate down on the bottom there, 4% fixed rate. You can just throw your money in a fixed interest rate if you want to, okay? So important that we look at this with our eyes wide open and throw all those biases out the door, because we've never seen safe investments this good, ever. Even back in the late 90s, when we had much higher interest rates, fixed indexed annuities were not anywhere near this good. Okay. We just owned bonds. We had no need for fixed indexed annuities back then because we can just own bonds. Interest rates kept coming down. We kept making more and more money. Everything was wonderful. But now we have to start paying attention, and these things have really progressed into a safe investment that we should all pay attention to. All right. Well, also, again, IRAs, we're seeing these extremely helpful in IRAs, especially for the last couple of decades with required distributions. These were the best investment out there. They compared to any asset class out there during that withdrawal phase of life. Holy cow, these things have done really, really, really well. Best category of investment for consistent withdrawing, like required distributions. All right, hopefully that helps. Just kind of running through all the different types of the safe investments that are out there. CDs have been rendered somewhat useless, even though we're intrigued and love these new 4% plus interest rates. They still just don't seem to be very consumer friendly. So let us know if we can help out in any way. We love chatting about anything. You want to talk about different safe investments or your best options? Give us a call, shoot us an email. Always here to help. If you haven't subscribed yet, we're putting out 3-4 videos every single week. So new, fresh information and lots of education out there. Jump in and explore all these videos if you haven't. See you next week.